modestly in January, but unemployment rate will still hold steady. There will be no lowering. This overall support views that the economy's sluggish recovery was on track despite the surprise contraction of the final 3 months of 2012. The closely watched report comes on the heels of data on Wednesday showing a surprise contraction in GDP in the fourth quarter, but the jobs data should suit any worries the economy was at risk of recession. Of course, we're talking about a release that will come approximately or around the expected levels. Anything below this would be quite disappointing. Recall the US GDP contracted 0.1% annual rate in the fourth quarter, largely because of sharp slowdown in the pace of inventory accumulation and the plunge in the defense spending, along with the monster storm that hit the East Coast in late October, also putting additional pressure on the final output for the GDP that came for the fourth quarter. Also, the Federal Reserve officials said on their latest meeting release on Wednesday that economic activity had paused, but they signal optimism the recovery would regain speed with continued monetary policy support, and the Fed, as we know, left a policy of monthly 85 billion bond buying stimulus plan still in play. The Labor Department, as we said, will release the January employment report at 13:30 GMT, and also it will publish benchmark revisions to payroll data going back to 2008. From markets, Super Euro called this morning from number of commentators continues to go higher. This morning's late Asian session trading saw the break above our next upside target at 136.00 with the 136.39 high seen so far. It seems that the euro is heading higher, and they're looking for a more significant corrective action of the larger downtrend that goes from 2000. The latest peak was in 2011 at 149.38 as we broke above the important 50% retracement level, and now opening way for some stronger gains and stronger recovery. British pound also well supported at the beginning of European session as yesterday's rally through 158.25, seen as a near-term breakpoint, approached next significant barrier at 159, 158.73 seen so far. Some corrective action might be preceding this rally, but still positive tone still sees the upside favored. Dollar yen remains the top performer as yesterday's fresh stretch above the 3 days consolidation under 91.40 on the upside and the 90.30 on the downside. Skyrocketed to as high as 92.28. This was the highest level seen in the early hours of European session, with the outlook still positive despite overextended conditions that we will elaborate more in our technical part, seeing potential for even further extension higher. Dollar Swiss remains heavily pressured, but so far finding support at a strong 90.80 base. This is the previous strong support that has again been tested, yet no break seen until now, with further consolidation, I would say, rather than any stronger corrective action seen preceding a fresh weakness according to the current situation in the technical view. While if we break above 92.00, then immediate bear pressure would ease. Crude oil remains well supported, though, in the corrective action of high of 2 days ago at 98.22, with the 96.82 seen so far. A brief break below the initial strong support at 97.00, 96.90 previous highs sees a bit more, I would say, potential for some stronger corrective action, despite the price bouncing higher yesterday up to 97.68. Near-term structure still does not rule out some stronger corrective action, while if we lose 96, then we will look for some further pullback. Gold is under pressure as yesterday's sharp sell-off and profit-taking that started from 2 days ago high at 1683, left a lower top yesterday at 1680, and the textbook failure swing appeared here. We lost important supports at 1678 and 1670 zone, dipping as low at 1657. Of course, now more pressure is seen towards the downside. It seems that the current corrective action of 1650 is likely over unless we see break higher, and that's are the highlights. And then we are going to, of course, go more into details. Though we were late this morning due to some technical problems, so I will try to be as fast as possible. A brief look at the calendar. Chinese manufacturing PMI released during the night came in rather disappointing, 50.4%, showing a mild contraction in the manufacturing compared to the 51.1 quite optimistic forecast, and today's release came below previous one at 50.6, while Japanese final manufacturing PMI for January, Chinese HSBC final manufacturing PMI for January came at 52.3, much better than 51.5 previous release and the 52.1 forecast. From Eurozone, as we have series of PMIs due to be released today, Spanish one came at 46.1, better than much better than previous 44.6, and beating the forecast at 45.5. Still we are below the 50 break point, showing that the Spanish economy is still contracting. Swiss PMI came at again very positive 52.5 reading in January versus 50.5 forecast that already signaled a possible break above 50 break point compared to December's release at 49.5. Still to come at 9 o'clock GMT. Eurozone, the final manufacturing PMI for January. According to the forecast, no changes seen in today's release compared to the release of month of December. 47.5 is the release. Half an hour later, UK's manufacturing PMI for January is forecasted at 51, below the previous release of December at 51.4%. At 10 o'clock GMT. Eurozone estimate, inflation estimate for December, no changes again according to the forecast, 2.2%, while European unemployment rate at the same time is expected to tick higher. 11.9% unemployment in December is seen forecasted for today compared to 11.8 in month of November. And then the top data come at 13:30 GMT. US non-farm payrolls forecast around 160, depending on the analysis hours. Is 161 versus 155,000 in the month of December. Anything around this or above would be a good signal for the US economy. I do apologize. While any disappointing levels significantly below today's forecast and previous month release would be another disappointing point for the US economy. Unemployment, as we said, is expected to stay unchanged at 7.8%, and some other data that are due to be released. We will highlight the University of Michigan consumer sentiment in January. That is for January. That is due at 14.55 and 71.4%. 71.4 is the forecast compared to December release at 71.3. And another final manufacturing PMI for January from market at 56.1 forecast for today. No change compared to the previous release. And basically, the more important is the ISM manufacturing PMI due at 1500 GMT. That is seen better than the December's release of 55.5. 56.3 is the forecast for today. You can also see from the impact of the release of the economic indicator. So anything in red is at the highest priority and has the strongest impact on the markets. Of course, the main focus is on today's U.S. Jobs data, and we are going to closely watch and see what will be the market action. Some expectations say that some analysts basically say that they don't expect something significant as most of the movements have already been priced in, but of course anything that comes above or significantly above or below the forecasted levels, of course, could trigger some stronger impact in the markets. And a brief look at technicals, as we are a bit short to the time. As I said, I apologize for a delay on the technical problem. I just want you to see the screen. It's still not showing for some reason. In any case, we will start. I hope it's just a delay in my program. Euro surged again through psychological, and the next target, 136.00 barrier this morning, hit 136.39 with the positive tone still dominating on the lower time frames, and holding a positive sentiment despite quite overbought technicals on both 1 and 4 hour chart that sees potential for some further extension higher, with the dailies also being quite extended at this point. Basically, we'll be looking for extension up towards 136.50 initially, and 137 as the next upside round figure resistance, with bullish momentum still being present, as said, and favoring a fresh stretch towards 137. And then we have 137.26. I think it's showed on the weekly chart. 137.26 is basically the 76.4% Fibonacci retracement of the down leg from 2011 peak at, is it? No, it's 2011 October peak at 142.46 down to 120.42. This will be the next upside targets in case of a sustained break. Of course, the weekly close above 136 is seen required to resume the current stronger rally of the single currency, and this, of course, would bring another significant psychological barrier at 140 in the near-term focus. Of course, some corrective actions should be anticipated, as hourlies are starting now to reverse from their overbought territory. 135.87 minus support is the previous highs of yesterday, and then 135.40. While from the Fibonacci levels we have 135, it's quite a good support. Pardon, 135.50, 40 is the lows of yesterday, and also the 20 days exponential moving average as dynamic support reinforcing this level. And then comes 135.00 psychological support, and the 38.2% retracement of the uplift from 132.64 to so far 136.39, while holding above 135 would keep immediate bulls in play, would not have any stronger impact on the bulls. Regarding euro, we are going to watch today's US jobs data. Of course, the batch of data due to be released from the Eurozone is also going to affect the performance of the single currency. British pound in recovery mode, breaking out of yesterday's break up of 158.25. That was seen as our break point. I think better seen on the 4 hour chart. Extended so far to 158.73. That its approach, basically to approach to 159.00, our next upside target, psychological resistance. 158.91 is the first static resistance, 23rd of January high, and then we have 159.00 and 159.25. Hesitation is now evident on approach to 158.90, 159, with the still positive technicals on the 4 hour chart, and the hourly is already reversing lower, suggesting that some corrective action might take place before the fresh bulls reassert for attack at 159.00. Any dips lower should be ideally contained somewhere above 158.25 or 158.00 in order to keep the immediate bullish structure in play. 158.25 is the previous high and the previous resistance, reinforced by 23.6% retracement, while 38.2% comes at 158.00, also around figure resistance, and basically any reversal above at or above these levels would keep focus at 159 as our next upside target.
slide below 157.75. That is yesterday's, 157.73. Yesterday's low, and 50% retracement of the corrective rally from 156.73 to 158.73 is seen as a break point, and that will be again bearish. Dollar yen remains well supported and heads north. The fresh stretch higher seen this morning hit at 92.28, clearing our initial target at 92.00. As we see on the 4-hour ADX, bulls are firmly in play, and they still see room for further extension higher. Also, it's daily ADX showing bulls heading north, and the possibility of further extension higher is quite likely. We can see the levels now only on the monthly chart, where we'll see the magnitude of the current recovery from 2011 low at 75.55. We're talking about something of 2 years recovery. That so far nearly fully retraced the latest down leg, the phase lower from May 2010 high at 94.97, and basically extension so high that 92.28 does not see much of obstacles on the way. 92.87, this is the high of June 2010, I do apologize, is seen as the next target, and the next barrier, along with the 93.00. That might open way for a full retracement and extension towards 94.97. Of course, corrective action should be anticipated, as all indicators currently are on the lower and the larger time frame studies are in the overbought territory, yet except a slight reversal of the hourly, slightly pointing lower. All the others are still heading north, and despite holding in the overbought territory, seeing potential for some stronger extension higher. But of course, we have to anticipate corrective movements. Initial support is 91.40, 91.24 previous highs, and then comes this is reinforced by 4-hour 20 days exponential moving average ahead of level at approximately 90. We have small problem now with our system. Give us just a few seconds. I do apologize for this. We faced some technical problems, technical issues this morning, and that's why we delayed our today's session. That is quite important, as is preceding US non-farm payrolls data. 90.73, 91 and 90.73 higher platform of yesterday, and then we have 90.31, 90.30. I would say break below 90.00 would put near-term bulls on hold and allow for some more significant corrective action. Holding above these levels is still keeping a main focus at the upside, and targets, as we mentioned, 92.87, 93.00, and the final push seen in the near term towards 94, 97, 95 zone, basically. Dollar Swiss, as I mentioned at the beginning, is still hesitating, consolidating above strong base at 90.80. That has already been briefly dented on yesterday's brief break lower, 90.74. But as we can see, the no trend at this point, sideways movements showed that the 1-hour ADX, while bears are still in play in the 4-hour chart and still keep the downside favored, with the hourly studies moving sideways now, but still holding in the red territory, and the upside being capped by initial 91.18. That marks approximately 23.6% of the initial down leg from 92.25 down to 90.73, slightly above this level. Break above initial congestion top at 91.20. That is reinforced by descending 55 days exponential moving average, and break above more significant at this point, 91.50 zone. Fibonacci barriers 50 and 61.8% is required to avert immediate downside risk of breaking below the 90.80 base, and possibly to open our next significant barriers at 92.00, 92.25, above which is to signal again near-term base and probably open way for some stronger corrective action. Otherwise, as we can see also the 9150 is reinforced by 4-hour descending 20 days exponential moving average, while 92 barrier has above it descending 55 days one, while the immediate price action is still maintained by descending 10 days moving average that overall still keeps more pressure towards the downside despite the oversold conditions on the 4-hour chart, unless we break above 91.50-70 seen as a minimum requirement, then more focus and more risk is seen towards the downside. As break below 90.80, that is reinforced by a weekly 90 days moving average, would open next levels at 90.40. This is the low of April 2012. 90.00 as psychological support, and also April's low. And these levels would be seen as our next downside target in case of a loss of strong support and base at 90.80. On the upside, we already mentioned. And a brief look at the yellow metal that is came again under pressure. Basically, the quick rally seen on 30th of January was seen as a false break as the market quickly recovered. As we said, the technical textbook failure swing recovered, and the sharp sell-off dipped as low as 1657, with the 4-hour bears now being again in focus. Being in play, pardon. The consolidative action above yesterday's low at 1657 is underway, but so far 1663, this is approximately previous resistance zone, and 1667, that is the 55 days exponential moving average for now capping. And negative structure is still dominating on the 4-hour indicator or 4-hour chart. Some momentum has been regained, but still lacking some more strong strength to recover further. 1667, as we said, is the 55 days exponential moving average, and the 38.2% retracement of the downleg from 1683 to 1657. If we see break here, then this will avoid immediate risk of fresh extension through 1657. That will focus again our base at 1650 zone, and break above 1650 and the 1673, that is 61.8%, and also the previous resistances would bring focus again towards the upside. But according to the negative tone seen on the lower time frame studies, more likely scenario would be still seen attack at the lower levels, as overall picture is still quite bearish, and the yellow metal is still in the downtrend, as recent failure to clear 1700 psychological barrier and descending daily 55 days moving average, as well as trend line resistance that is approximately there at 1696, still keeps more pressure towards the downside. Yesterday's denting 200 days moving average is initial weakening signal, and today's close, weekly close below the 200 days moving average that is currently standing at approximately 1663 would give a more negative tone to the yellow metals near-term price action. Of course, all instruments now are awaiting the release of U.S. jobs data to give some more clear, more light in the near-term direction for the major currencies and commodities, and that will be all for today. I do apologize, we will skip the questions and answers pardon, session, as our next session in Arabic language starts in a few minutes, and we have to give them some space to continue, my colleagues to continue. Keep an eye on today's NFP data, as this is the key release. Of course, the other data that are due to be released before are also quite important. You can see it from our calendar. Wish you nice Friday and very good and successful trading today. Just watch not to be caught against the trend. Of course, wish you nice weekend, and expect to see you on Monday at our regular time at 8 o'clock GMT. Good luck.